Hey, welcome to our weekly segment where we guide you on your journey to financial literacy.
We like to make these videos short and sweet in hopes that you learn a new economic term while keeping you updated on 3 financial events that happened in the past week.
Without further ado, let's get right into it. Job gains of 850,000 were stronger than expected, while payrolls for the previous 2 months were revised higher by 15,000. 40% of the gains came from leisure and hospitality, the sector most hurt by the pandemic. While hiring in hospitality has outpaced other sectors over the last 5 months, it has a lot of ground to make up. Employment in the sector is still down 13% from February 2020. Considering the broad availability of vaccines, increased consumer savings, and pent-up demand for in-person experiences, many view this gap as room for further improvement rather than a threat to labor market recovery. Education, another area hit hard by the pandemic, was the second largest contributor with 286,000 employment gains. State and local government hiring added the most jobs in 10 months. Robust tax revenue and funds from earlier stimulus bills will likely support further hiring. One of the biggest risks to the equity market rally is that central banks will tighten policy aggressively and earlier than expected, so the Fed's interpretation of the labor and inflation data is critical. Despite robust gains last month, total employment is still 6.8 million short of its pre-pandemic level. With the numbers a long way from the Fed's goal for full, broad-based, and inclusive employment, there is no urgency to push the shifting policy timeline forward. Many expect the Fed to take a patient approach in reassessing the case for ongoing policy accommodation. As businesses have ramped up capacity to meet increased demand, worker shortages have impacted hiring, holding back the recovery. The most recent Labor Department report showed that open positions in April soared up to 9.3 million, enough to absorb the entire shortfall in jobs since the pandemic started. Strong and accelerating payroll gains may show us that the worst of the labor shortages might be behind us. Higher wages could pull more workers back, yet 3.4 million people are still missing from the labor force. The participation rate held steady last month, remaining well short of pre-pandemic levels. Anyways, that pretty much wraps up the 3 new segments for this week, and I'm going to hand it off to Om to discuss our financial term.
Many of us know the fairy tale of Goldlocks and the Three Bears as one of our earliest childhood memories. However, few of us would have thought that the childhood tale would apply to our lives today. And that is exactly what we're going to discuss for our financial term of the week, a Goldilocks economy. If you recall, one of the highlights of the Goldilocks fairy tale was the temperature of her porridge. One bowl was too cold, the other was too hot, but one was just right. In the exact same way, a Goldilocks economy is considered the ideal state for one, or to continue the analogy, the perfect temperature. It's not too cold where we're nearing a recession or too hot where inflation risks occur. It's just warm enough to fend off a recession, but also just cold enough to avoid inflationary risks. This one's pretty straightforward. It's just about rising asset prices, such as rally in the stock market or rising house prices, that generally hint towards a growing economy. A concept we should all be familiar by now during the lockdown, lower interest rates are a form of monetary policy by the Federal Reserve. Or in other words, the Federal Reserve's attempt to control inflation or control the economy by manipulating the flow of money in the free market. GDP is a key macroeconomic indicator that provides insight to an economy's current state. Our last financial term about arbitrage, we learned about the supply-demand equilibrium and how there's an ideal price point. This applies to GDP as well. There's a given point where the GDP is considered ideal, and if it misses that point by either overshooting or undershooting, it can hint at general recessions or inflationary periods. Also, this one's pretty straightforward. It's just that low unemployment rates hint at a growing economy as more Americans have more jobs, which means they're able to spend more. And of course, consumerism is what drives our economy nowadays. Low inflation is key because we are experiencing all the benefits of a growing economy during the Goldilocks period while also not worrying about inflation. That's what makes it exactly. Finally, for investors, this is pretty much a perfect time to invest as Companies and the economy in general, of course, is just growing, but there's no yet hint or threatening of inflation. So mostly they're just reaping the rewards without many of the risks. Companies show upward trajectory in revenue and return profits to their shareholders, either through stock or dividends. Also, without inflation, fixed income assets like bonds hold their value. That's all for this week. Thanks for watching and hope you join us again for next week with our weekly segment.